Over the last several months, we have seen a total collapse in the volume of housing transactions and the early signs of price declines throughout the country. In this video, I will update the current state of the US housing market, both volumes and prices, and then I will provide an outlook on what to expect in 2023 based on several reliable leading indicators. Volume leads price. First, there is a decline in the number of transactions, and then prices decline months later. Because volume leads price, let's look at volumes in the US housing market first. The housing market is split into two segments: existing homes and new homes, or new construction. Existing home sales, which make up about 85% of total home sales, peaked in 2020 with an annual sales pace of 6.7 million. The volume of existing home sales has completely collapsed to 4.1 million, a decline of roughly 40%. Despite the fact that existing home sales volume has collapsed, the month supply, or the ratio of home sales to home inventory, is just 3.3 in the existing home market. A balanced market, or the perfect dynamic between supply and demand, is a month supply of about 5. So you can see how the existing home market has had tight inventory for the last 6 years. The new home market is a bit different. New home sales volume has declined a similar 40% from over 1 million annual sales to about 600,000 annual sales, but the month supply exploded from under 4 to almost 9. There has been a slight increase in the volume of new home sales and a corresponding decline in the month supply for new homes, but this is not accurate as the cancellation rate is rising. Many people are buying new homes and then canceling the purchase. These cancellations are not captured in the Census Bureau or government data, so we are likely seeing sales data overstated in the new home market. John Burns Real Estate Consulting gives us some better data and shows us how there were 46,000 gross sales in November, but about 11,000 cancellations, leading to 35,000 net sales. This gap between gross sales and net sales has been widening in recent months, which means our new home sales data is actually worse than it's being reported. If we take the data at face value, we can see that in the total US single-family home market, we were selling at an annual pace of 7 million in late 2020, and we're moving closer to an annual sales pace of 4 million as we enter 2023, a decline of roughly 40%. So the volume of transactions in the US housing market has collapsed, undeniably. The month supply of the total US single-family housing market is 4.1, which is very tight. Remember that about 5 is a balanced market, so when the ratio of home sales to home inventory is below 5, that means there's not a lot of inventory, and many people said that home prices would not fall because of this tight inventory situation. The month supply of US housing at 4.1 is made up of existing home month supply at 3.3 and new home month supply at 8.6. There has never been a split like this in history, and this is throwing off many people who are looking at the situation without considering this nuance. If you run an analysis between future home price growth and the month supply of total US housing and the month supply of new US housing, we can see that the month supply of new US housing is a better predictor of future home price growth. So many people are looking at the total US housing inventory situation and saying prices cannot fall, when in reality, new home month supply is a better indicator because home building companies tend to be price setters in many communities. We should also remember that the month supply number of 8.6 for new homes is likely too low once we account for the cancellations. So the reason that home prices are falling is because the month supply of new homes, the better predictor of future home price growth, is at the highest level since 2008. And with sales volume collapsing, there is no sign that this ratio will fall in the next several months as we head into 2023. On a national level, we can see home prices have officially peaked, which many people didn't see coming because of the false supply narrative. But in truth, the declines are not happening equally across the country. Places like Miami are barely declining, while San Francisco is completely crashing. The Case-Shiller Home Price Index measures the 20 major cities across the United States, and this graph shows us how much home prices have declined from the peak, which was around the spring or summer of 2022, depending on your local market. Places like Chicago, Cleveland, Atlanta, and other parts of the East Coast like New York and Miami haven't declined more than 2% from the peak, so many people in those markets are saying that they are not seeing home prices fall, and they are likely correct. However, when you go over to the West Coast and look at San Francisco, Seattle, San Diego, and LA, home prices are down 7 to 10% on average in just 5 to 6 months, which is a total crash. That means home prices are declining at a pace of almost 20% per year if this keeps up, and based on the leading indicators I'm about to show you, it's very likely that this decline in the US housing market does continue at this pace and maybe even get a little worse. Over the summer, I made a video about 3 factors that tell us where home prices are going, or leading indicators. I talked about the liquidity provided by the Federal Reserve, the spread between mortgage rates and treasury rates, and the month's supply of newly constructed homes. M2 growth, or money supply growth, continues to decline and is now contracting for the first time in over 30 years as the Federal Reserve is raising interest rates and slowing down credit creation in the economy. Mortgage rates usually track treasury rates, but today, the average mortgage rate is 2.76% higher than the 30-year treasury rate, which is near the highest spread in over 30 years, a signal that there is risk in the mortgage market and lenders are being cautious. Lastly, as we mentioned throughout this video, the month supply of new US housing is still rising, and there is good reason to believe that the real number is actually even higher due to the cancellation rate surging. So we have a cocktail of declining liquidity, rising mortgage spreads, and rising month supply of new US housing. This is exactly the same recipe that I called out in the summer of 2022, almost 6 months ago, that told us home prices would decline. So it's very clear that in the first half of 2023, we should see a continuation of what we saw in the second half of 2022, which is a continued decline in US housing volumes and home prices that continue to decline with the normal differences across the country depending on your local market.